Joining us today, we have Pierre-Paul Turgeon. He's the owner of Multifamily Investing Canada. They teach people how to get started in multifamily. He owns Matterhorn Investing, so not only teaches, he also does. They have over 20 million worth of property here in Edmonton. He had a long career in CMHC before, which I find really interesting. I think it gives him a lot of credibility there. What else you want to add? Adventurer, maybe, onto the list?
Yeah, outdoorsy, hunter, skier, you name it, camper, world traveler.
Good. So if you don't mind, let's just start with the CMHC. I know that's kind of your background. Do you want to give us just a brief history on that side of things?
Yeah. So as you said, Shane, I'm a full-time multifamily investor like yourself with a portfolio worth over $22 million in Edmonton. My story at CMHC is quite interesting. I started back in 1997, I think 96, with a kind of a temporary contract for CMHC International. So CMHC was starting an international branch, so pretty cool stuff. And they created an international division, CMHC International Division, which basically its job was to give consulting advice to foreign countries on how to set up what we have in Canada, mortgage default insurance. So I was a project manager there and on international housing finance projects. So I worked, like I was saying before we started recording, in places like China, the Middle East, and this is my claim to fame. I've rushed upstairs to show you. I helped create PMHC, Palestine Mortgage and Housing Corporation, which is still in existence. So that's West Bank and Gaza. Worked in Romania, China, India. So yeah, just setting up mortgage defaults or helping these other countries set up mortgage default insurance. You and I sometimes may complain against the system, financing system in Canada, but despite that, it's one of the best financing systems in the world with its flaws. Some countries don't have a financing system. So that's sort of, I was more on the managing these international projects, Shane. I wanted to get hands-on experience on CMHC's core expertise, which is mortgage default insurance. And just to be clear, what we're talking about is the banks, they lend you money to finance your deals. CMHC comes behind and insures the loans against defaults by us investors. So that's what mortgage default insurance is. So I was managing these international projects and I didn't have hands-on experience in the sector of mortgage default insurance. So I asked to be transferred to the Calgary office in the insurance sector. I did a little bit of single home underwriting people's residences and so on. Then they yanked me out of there. They put me in charge of default management and real estate in the regional office here in Calgary at CMHC. And that's important, Shane, because as you said, I teach this stuff as well, how to invest in multifamily properties. You're one of my former students. I manage the defaults of apartment buildings and the real estate side of things. When CMHC, private homeowners default on their homes, the banks has the responsibility to try to sell them to limit the claims against CMHC's insurance fund. And after a certain exposure time, a year or so, if the banks are not successful at disposing of these assets, these smaller homes, I was managing a small department called real estate department that was trying to, again, market these units until we sold them. But then so that's one half of my job as a manager of default management to real estate department. The other half was managing defaults of apartment buildings. And what I say always with a big smile on my face, Shane, is I was so bored out of my mind because apartment buildings, as you well know, rarely default to this day, despite COVID, despite the upcoming recession, which I think we're in probably already by now. So I was bored out of my mind, I had no defaults to manage. So I switched to the multifamily underwriting department where the action is. And I saw how much money people were making. And I said, okay, I'm going to do that when I grow up. And in 2010, I left. And the rest, like is history. I also teach this across Canada now. We'll talk about that. I have workshops and stuff like that. That's what I do. And I speak around the country. That's sort of in a nutshell my story.
Yeah, very, very good. So when you're in overseas, like or dealing with the other countries, what do you find is the biggest difference between the housing market here and there? Is home ownership higher, lower?
No, home ownership is much lower, Shane, much lower. There are many countries, and just to appreciate, I don't mind answering the question, but it's been a while since I left that international business. I left in 2002. But the biggest problem abroad, they don't have a sound housing finance system. They don't have stuff like land titles to keep track of titles. The financing system is on very shaky grounds. So they don't even have the infrastructure to begin with to have a housing finance system. So the challenges that we were facing were quite significant. But the majority of them are not owners; they're renters. And I don't want to jump ahead of this conversation, but I can tell you that our country, Canada, is fast moving into a nation of renters, just like it is in Europe. Most people are renters, and it's. I mean, I don't want to be a renter. I'm glad to have a business being a landlord. But unfortunately, your kids, maybe, and my kids, which are older than yours, the likelihood of them being renters is extremely high. Yeah, so that's some of the issues that we see when we go abroad. People are renters, and it's not perceived as negatively as it is in Canada. And quite frankly, the former CEO of CMHC, actually, he's retired a couple of years ago. Evan Siddall said it: the homeownership part in Canada is over. So we have to change our mentality. But at the same time, we have lots of problems. We have, you and I were talking about, we started recording, a severe housing crisis in Canada, which is just beginning to explode. This is causing already social upheaval and tension, and we haven't seen the end of that, Shane. That's my take. We can expand on that if you want, but that's what I saw abroad. We're very lucky, despite its flaws. We have a very good housing finance system in Canada, one of the best in the world, and I'm just finished on that. We saw that in 2008, 2009, the Great Recession. You remember the subprime market debacle in the U.S. We never had that. About only 5% of mortgages in Canada are subprime mortgages. So the underwriting system works well. Although I think there's a risk right now with the rise of interest rates so fast that the rate of default is increasing a little bit, is what I'm understanding.
Yeah, well, on the becoming a renter nation, I've been preaching that for a while. I think that's the way we're heading. I'm one of the few people who, by choice, I rent. I don't know where I want to live for the next couple of years, or if I want to live in the same house for the next couple of years. So I choose to rent.
Well, you can't be that dumb. Can't be a dumb decision. But I believe that Greg Cardone is also renting. If I don't remember, if I remember correctly, right?
Yeah. Well, it's funny, and now I think more and more people, like, there's the book. It's called The Wealthy Renter, and I think it is a lot more acceptable, and increasingly will be.
Nothing.
But some of it's out of force too. It's out of not by choice. You did mention the recession. I'd be curious to get I know nobody has a crystal ball, but you think we're sliding quickly into it, or it's going to be kind of mild, or what are your thoughts?
I think it's the latest employment numbers that are very telling, right? Canada created 150,000 jobs in January. So there is still an overheated economy. Yeah, I read about macroeconomics a lot. I'm fascinated by it. I hated microeconomics, but macro I quite dig. And again, just before we started the interview, I saw a clip with the governor of the Bank of Canada, Macklin, saying, I said we'd take a pause on raising interest rates, but he just said basically what I just said. But the latest numbers, we'll see at the next March meeting what comes out. But it's so messed up, Shane. Like you said, I'm not an economist, but I do understand the mechanics of it. And the normal parameters that we would use to answer such a question are kind of out of the water. Like it's a leftover hangover, I would say, from COVID with regards to procurement issues, which were in place before COVID. Most people don't realize that, but COVID just exacerbated these procurement issues, or the supply chain issues, if you will. When I say procurement, that means supply chain issues. And then you had all these benefits to keep people in the economy. The federal government was very generous. So people started taking their retirement, and now we have labor shortages. But the fundamental of our economy is somewhat strong. If I were, like you said, I don't have a crystal ball, but if I were to guess, I think it's not going to be a too severe recession, but I believe we're at the beginning of one. Yes, that would be my take. But again, all the markers, macroeconomic markers, are so off. It's hard to tell. But I'd be inclined to think so.
Yeah, and I guess I'd be in the camp that I think here we're both in Alberta. Obviously, I think we'd weather it a little better than the rest of Canada just because the energy sector. I don't know why.
I mean, completely. So I was speaking generically. If you want to zero into where you and I live and have our businesses, no, that's a different story. It's a good story. No, we're different. Home prices haven't crashed like they did elsewhere. They're actually on the rise, right? So, and the demographic growth here that we're experiencing, as you know, is spectacular. So we're in a different kettle of fish here in Alberta, but we've been suffering. You haven't been around long enough, but you and I chatted about that. It's been harsh environment to operate in Alberta as a landlord, because it's a much smaller market than elsewhere in Canada. It's not a Toronto, GTA, Vancouver, Montreal. And as you know, and this is a warning that I'm giving you, if I haven't given it to you already, it's an incestuous world. There's a few large players, REITs. I don't know if we can name. I mean, the Main Street is my main competitor, probably yours as well. But they've had deeper pockets. They buy at 80 cents on the dollar those properties, cash oftentimes, so very little financing. So in times of recession like we've been having since the crash of the price of oil, they give huge incentives. So we've been in an environment the last 6 years where rental incentives were given to tenants. So it's one thing when you have deep pockets like Main Street Equity. It's another one when, I'm a small potato with 136 doors in my portfolio. But yeah, things are changing, and for better. The oil and gas, the economy is diversifying. I was seeing what's going on here in Calgary, for example. The tech sector is doing extremely well with some incentives from the provincial government. So my point there is that the economy is finally diversifying, which has been lacking. Historically, the economy in Alberta focused too much on a single industry, which is oil and gas, and we're seeing that in Edmonton as well. Very, very optimistic about Edmonton, as you know, with the transition, the green transition, the consortium. Edmonton's been dubbed the hydrogen capital of Canada, and they're investing. The large oil companies are investing a lot of money. That they've created a consortium to invest in making that green transition. So we were already a world leader in greener oil, if you will, but now we're really, they're stepping on the pedal. So I'm very hopeful, and vacancies are coming down. You and I were chatting about that. We hardly have any vacancies. Rents going up. I gave my first rental increase, just to give people an idea how bad it was the last 6 years. My first rental increase in 6 years. Meanwhile, you know what's happened to operating expenses, Shane, whether it's the carbon tax, utilities, insurance. It's insane. That's another crisis in Canada. So that gives you an idea how hard it's been, but we're stepping out of it. And, the future looks pretty bright because we are in this severe housing crisis. They don't build enough rental accommodation houses in Canada. That crisis is, mark my words, it's going to be the next issue at the next federal election. It's going to be housing. It's a severe crisis, and landlords like you and I benefit from that because that puts downward pressure on vacancies and upward pressure on rents. So finally.
Yeah. So yeah, 100%. And my worry about that being a political issue is always that the solution for one side is going to be rent control. And I think that does the exact opposite of what it needs to, but it buys votes. And you see, there's a party in Alberta that already has had lots of meetings about this. They'll have all these Zoom calls and stuff talking about rent control, even though like a huge portion of we are affordable. We're the most affordable place you can live, essentially.
With the high salaries in Canada, by the way, right? You know that.
Yeah. So the only reason, in my opinion, we have that is we have the supply. People want to develop here because it's very easy to develop, and there isn't rent controls. So you have the upside. I obviously, I don't think rent controls help, but that would be, I don't know if that's a concern of yours, but
it sure is. And unfortunately, that the Neo-Democratic Party in Alberta is high in the polls. So I am definitely concerned about that. But yeah, there's not much you and I, that's outside our scope of influence. But as you said, the rent controls don't work. It's a fact that's been researched somehow, but the politicians want to appear to be doing something. To be honest with you, Shane, to your listeners watching, you just look at BC and look at Ontario, just to pick two examples, where the housing crisis is the most severe. They have very tight, stringent rent controls. That's a case in point to show that it does not work because landlords like us, I'm not one of those. You're not either. I know you enough to say that. I put money, I upgrade my units and all of that. But when your expenses cannot match, for example, right now, the inflation rate, a lot of landlords, and that's the case in older housing stock, namely Ontario, I have in mind, where the owners, the landlords, don't put money back into their units, so they're decrepit, and developers are not inclined to build more because you're limited. So it's not an issue of how much we charge in rents. It's purely an issue of supply. It's the lack of supply, and the incentives are not in place. That's a problem I follow very. I can go as far as you want if you want in terms of my analysis there, or as little. But I'm strongly opinionated, and like I said, it's a significant crisis in our generation. This housing crisis.
Well, but my thing is, I've never, and maybe you have this answer, but I haven't ever heard someone really have a good solution for what we can do. You have them raise interest rates to slow inflation, that stifles development. You talk to home builders on how many people are not getting approved for houses today. Well, those are all houses that they're not going to build for no one to buy.
No.
So that's
yeah, I know. So this is a pet peeve. So like I said, Shane, I'm extremely well read, like daily. Yeah. It's a big issue. So no, there are solutions, but the solution is not rent control. That destroys the market. And unfortunately, politicians, they won't vote, so they'll do what the common people, not the business owners. But you and I know both. You were a business owner before me at a younger age. But my coming out was really when I left CMHC and all of that, and I started buying apartment buildings. It's a reality that I've understood, right? You got X amount of money coming in, and so you can only spend so much, right? And you have to have a surplus. Unfortunately, we have governments, whether it's at the municipal, provincial, especially the federal level, that don't seem to understand this basic concept of spending, less than what's coming in. But specifically, solutions. The biggest challenge that we have is at the municipal level and zoning and the red tape. Okay, it's taking too long to develop for developers to be able to get permits. It's costing too much. So that's the biggest issue there. So you have that, and you have, like I said, rent controls that hamper that. I find that my former employer, CMHC, is doing a bit of a better job. Like, I don't know if you want to talk about MLI Select. That's a new product that came out just about a year ago in March of 2022. I think they're handing out $500 to tenants now that are having a hard time paying their rent. But unfortunately, the biggest, the most important jurisdiction is at the municipal level, and there's red tape, inefficiencies, and so on. It's taking too long. But there are solutions out there that are starting to come out. But the government has to. You gotta unlock land to build more. You gotta densify the current existing cities, which is one thing that Toronto's trying to do. But there's a lot of upheaval there with the Green Belt and the West End. I don't know if you follow that stuff. I do. So there are solutions out there, Shane. The challenge that we have, it's a federation Canada that's not working well together. Whereas the provinces are those various levels of government, municipal, provincial, federal levels of government have to work together. They're not at this point. But I'm telling you, I hope they do very, very soon. One of the articles I read this morning is Wake Up Canada. This housing crisis is severe. They want to bring in, those numbers, right? 500,000 immigrants every year. Well, those numbers, there's already way more than we know in the stats. So I think that crisis is going to hit the fan this year or next year. I think it's going to be huge. So there are solutions out there, Shane, but the three levels of government have to work together, talk to one another. And they're not really at this point.
Yeah. Well, that's what I don't know what I'm all for the immigration. Like, it's very good for business. I think it's good for the country.
Agreed.
I just don't understand where physically where we're going to put everyone when even now that Edmonton, Calgary are down in vacancy, everywhere is around 2%. We don't have the units. I don't know where.
That's what I'm saying. I completely agree with you. Yeah, so they're saying they're going to bring all these immigrants, but they haven't solved the housing problem. So where are they going to go? The only good thing, and I don't want to sound mean, like a mean landlord, like we're always coined, right? But it's good for you and I, because that's going to put, again, pressure on vacancies, downward pressure on vacancies, and upward pressure on rents.
Yeah.
So I'm happy to be a landlord. But it's been 6 years, like I said, in Alberta, that were very difficult. But no, they're not. Like I said, it's going to get way worse before it gets better.
Do you think that you mentioned that CMHC, the new program that MLI Select? One thing, I guess, on the development side, though, is you have to lock rents in before you start, right? Or say what your rents are going to be.
You've got to provide always got to the underwriter at the other end, at CMHC's end, needs to know what the income is going to be, and then your expenses. Yeah, and they have to be secured. I didn't bring that stuff down with me in my studio here, but yeah, I think you've got to lock them in for like 10 or 20 years. You have the choice, and then it's a scoring system. If you keep it below the 30% of the median income, renter income, and they have stats for each province, what that medium income is. And as you said, in Alberta, where I think it's $1,600 a month here, that your proportion of rent, and we're not there like that. That would be newer units. The average is way below that. I know that. So for a 2-bedroom, it'd probably be about $1,200 or something, I would say, roughly, that vicinity, depending on a number of factors, age and location. So it is a good step in that direction. The only problem is they kind of started implementing this program at the same time as interest rates started shooting through the roof. So now developers are saying, okay, CMHC has these great flexibilities. Let me expand a little bit on some of these flexibilities, actually. You can first amortize up to 50 years, which was unheard of. The maximum amortization before that under CMHC was 40 years. You can also get up to 95% loan to value financing. Okay, that's huge. Like, it used to be maximum 85%. So it does, it does provide some flexibilities. And the three sort of social goals we're trying to accomplish is affordability. Then the second one is accessibility, and then energy efficiency. If you convert your building to more energy efficient systems, you get these points. And so the premium is a lot lower, because the maximum premium was 4.5% of the loan amount. Now I think you can get something like 1%. So the mortgage default insurance premiums are much lower, longer amortization. So it does enable. But the only thing I think and I know that it's a very popular, I've got to do one of those, by the way, come March. My lender's after me because we're renewing in September. Get this. The renewal date is September. And my lender's been after me since last fall, I think October. When I spoke at that association where I first met you last October, for a renewal happening in September 2023, just because CMHC is overwhelmed with that new program. There's a lot of applications. So it is a good program in that regard. There's always few things I don't like about it. Like, you can get a DCR, debt coverage ratio 1.1. So you're barely covering, first of all, the numbers that they use are skewed. They're screwed, I should say. But they will allow you to have a DCR of 1.1. So that means your NOI just barely covers your mortgage payments. So that doesn't give you much of a buffer there. So you better be careful. So even though CMHC will allow that, because before that, I don't want to get too technical with people. Sorry, I think I am already too technical. But the minimum debt coverage ratio was 1.3 for CMHC 5-year loan term. If you go down to 1.1, you hardly have any of a net cash flow there. So that's scary as well. So yes, it provides some flexibilities. I just want to warn the other investors listening, do your analysis carefully, because there's a downside as well. So just saying.
Yeah, I think we've talked about that a little bit in the past too, where I think where new investors probably get in trouble. I think that program works great at scale.
Yeah.
I think on a smaller property, if you're buying $1 million property and putting 50 grand down, even at a 10% return, you're making $5,000 a year. So the odds of you clearing anything and not losing money on that property, I think is pretty low as far as cash flow goes. But you obviously have followed this now. I know I've heard you talk about this some, but where would you say like I haven't been here long enough to do the boom and bust thing yet. We came right at the beginning, right before COVID was just kind of taking off. But as far as the energy sector in Alberta, from everything I see, it looks like it's in a great spot.
Absolutely, Shane. You and I think alike. It's in a great spot. I think I share with you. I think it's when you were on my podcast before Christmas. If there was one thing, it's not a mistake that I made in my investing in Alberta when I started back in 2004. But the one thing coming from Eastern Canada that they did not know was the oil and gas industry, right? I thought it was a smart aleck. Hey, CMHC former underwriter, I knew it all, right? Except for the oil and gas sector. So anybody wanting to invest in Alberta, and I know some people that come from Ontario that don't know, and I think they're, what's the saying in English, counting their eggs before they've hatched or something like that. I would caution people, yes, boom and bust has been the history of Alberta. You got to understand the oil and gas industry. So much has changed in my own, so that's, if there's one thing that I know better now, because it is a primary industry that moves the Alberta economy. If you want to invest here, you need to understand how the oil and gas industry works. What caused the fall of the price of oil, I guess now in 2015, starting in 2015, is basically a surplus of oil as a result of fracking, which was this new technology that came on board, right? So now you have Canada doing some fracking as well, over and above the oil sands, obviously, and the US in particular, that changed everything. The one thing that you may not know, and this is very cool, something I've learned, like I said, I'm now very well educated in oil and gas. The oil production for these wells, at least I think it's the same in Canada, but the stats I have is for the US, goes down by about 30%. So when you do fracking, they pump up water to bring the oil up to the surface. The volume of oil that's produced in that fashion goes down by 30% per well per year. So within 3 or 4 years, you don't have anything left to pump. The only way to keep the machine going and the financing system and Wall Street going is to drill another well. But you understand, and we're coming to the end of the shale oil, which is why we also have an energy crisis in around the world, right? So, but that's what caused the price of oil to go down. At the same time, you had the digitalization, I hope I pronounced this well, pardon my French, of the technology. I have a buddy of mine that's an engineer from Serbia, was an oil engineer back in Serbia, moved to Canada. He used to run overseas a bunch of wells in northern Alberta, with 100 people. Now, most of it is all digital. So it's not creating as much employment as before. Okay. So, but I've had some of my shareholders worrying about, oh my gosh, like everybody's going to move to electrical vehicles and we're not going to need the oil anymore. Excuse me. There'll be several generations. I have time to start another family. Well, I wanted to, which I don't intend to. I've been married 25 years, very happily so. But you know what I'm saying? There's no other resource like oil yet. We need to continue to develop these alternative sources of energy, but they're nowhere going to take over oil and gas. Just so that another interesting stat. And like I said, appreciate all the education I had to do for myself. In 1 barrel of oil, do you know how much manpower, a person energy goes into 1 barrel of oil? 4.5 years of a human being in 1 barrel. I drive a Ford F-150, a good Albertan that I am, and hunter and all of that. I can put 4 or 5 of these in my pickup truck. Imagine that. We don't have an energy source that can replace that. All the petrochemicals industry. My wife is a nurse in cardiology. All the medication and the tools. We need oil for years to come. So I'm very, very optimistic. But at the same time, the oil and gas industry needs to wise up. I hang out, I vacation with very filthy rich oil and gas people. And I tell them, you guys screwed up. You should have done better PR job and not abandoned these wells in Alberta. They messed up as well. And the PR job, they let all these freaking Hollywood, stars come and crap all over the oil and gas industry. So they did a poor PR job as well. And they made mistakes, which for those your listeners elsewhere, maybe out east like I used to be, from Quebec, the oil and gas is cleaning up its act. They're the world leader in energy green transition. And If you don't know about the Albertan spirit, it's amazing. When they decide to do something, they do it. And I think you can vouch for that. A few years you've been in Alberta, and you're one of those pioneer and very dynamic, person in Alberta. So, but yeah, I'm not worried about oil and gas.
Yeah, and I think on the cleaning up their act, you like I don't know if it was during the Super Bowl or watching the Canadian ads, but you'll see them come up. Now they have that whatever the group of the big four, and they'll run ads on how they're doing the green energy.
Should have done it a long time ago, my friend. Yeah. Long time ago, but yeah, but it is also happening. But we need to phase out oil and gas, but it's never going to be phased out completely. And at the same time, I can go on. It's one thing for us, very rich countries like Canada and Europe and the Western world, to say, "Oh, we're going to phase it out." What do you think about those other poor developing countries? Right? They need it. It still is the cheapest source of energy. What? They're not going to develop, but they're going to cap oil. You know that. Imports of oil in India are increasing. China is now reopening after the COVID restrictions. Oil is not going anywhere. You and I have time to make lots of money before that oil disappears.
So I don't know if you ever actually mentioned, when did you move to Alberta? How long?
2002. 2002.
And was it for work, or why did you move?
I moved, actually. That's when I wanted to learn. So I was at CMHC International in the head office in Calgary, Ottawa, and I wanted to learn CMHC's core business, which is mortgage default insurance. So I moved from Ottawa, CMHC's head office, to Calgary regional office, and started working in the mortgage default insurance sector in 2002. By the way, the oil surplus, we all got a fat check, like surplus check from Ralph. Is it Ralph Klein? And back in the days, I think we got $600 or $700, all of us, every citizen of Alberta. It was crazy. The boom was just insane, Shane. Unbelievable. Never seen it. People were working, but people work hard. You need to understand, Albertans are hardworking kind of people. Yeah, so it was pretty spectacular back in 2002 here. People, even municipal works, people working night and day with lights in the middle of the night like that. The feverish pace was just pretty spectacular. Something I'll never forget.
Yeah, that is one thing. I think people who have lived in Alberta their whole life that don't know any different, that's hard to appreciate. Is that just the spirit here is. I mean, we came from Manitoba, but the entrepreneurial spirit or the business friendly spirit here is definitely very, very alive, and it's pretty cool to see.
And the innovation as well that takes place here, like I said, same thing with the oil and gas industry, right? They reduce carbon emissions. People don't know this much, and they don't mention that in that ad that you're referring to, because I'm very happy to see it. I've been saying, like I said to my friends in the oil and gas, come on, you guys, like, do the better PR job. But it's the media is not interested. But they've reduced emissions already by 30%. It's this country has a debt unforeseen. Yes, we needed to increase the debt during COVID. Something needed to be done, but the government was overly generous. Well, what kills me is we have Canada is definitely broken. If you don't figure out which political allegiance I have, but not because that. Well, you've said it. I see that it's our healthcare system. It's our school. It's our financial system, our deficit, and we're saying, hey, we won't sell the cleanest oil and gas in the world that we have, and leaders in that energy transition, because there's no business case. That's what our Prime Minister's been saying to the German Chancellor and to the Prime Minister of Japan recently. Are you out of your freaking mind? And while some people in Europe have a hard time heating themselves this winter, this is just so. It's a tragedy. I think it's terrible. And we're missing an incredible opportunity to be at the same time a leader in green transition and help the rest of the world provide cheaper energy. So it's unfortunate, and we're not productive in Canada anymore. Our productivity level is down. Investors are not coming to Canada. So it's a broken country.
I'm just curious, when you lived out east, though, would your views have been the same, or just didn't follow it?
I was never a separatist. And it's become an issue for me when I go back home. I got to watch what I'm saying. I couldn't say something like I just openly said with my butt and your butt sitting in Alberta. When I go east, it's become a little bit of a problem with family members. I'm a bit of a unique kind of character in that you know, you've heard I'm well traveled. I still travel quite a bit, and I speak a bunch of languages. I read The Economist. I read everything. I read a ton. I read fast. I went to law school. I'm highly educated. So I've got this world, and I lived abroad in many countries. I've been around the world once. So I've got a worldly perspective on things. And like I said, I love macroeconomics. So I have a unique perspective, which I understand not everybody has the privilege that I have, and I do feel privileged. I always carry my gratitude rock. Hey, by the way, I should pull it out. At some point, it's going to come in handy. That I picked up on the shores of Lake Titicaca on an adventure trip to Machu Picchu with my son. So I do have strong opinions, but I have a very keen sense of awareness because of highly educated, reading a lot about everything all the time, every day. I read a lot. Yeah. So yes, it causes problems when I go back east. I did not understand that Western reality that I do now, which is highly unfortunate that many of my fellow Quebecers don't understand. But then again, I go to Toronto. I went to school in Toronto. I went to U of T. Got a degree in political science, as a matter of fact, and law degree also from Ottawa U. So not everybody has the privileges that I've had to travel, be well educated. So at the same time, I understand why they're not as aware as I might be. But like I said, we're losing the country we used to have. This country I used to be very proud when I was 17 years old in South America on an exchange program back in 1980. The pride that Canada was. It's fortunately I'm urging people to read more, to be more aware, because not looking good. And I'm an optimistic guy usually. So anyways, I heard for Canada, Shane. That's all I want to say.
Yeah. Well, I do think, I think the pendulum is I think that comes back. I think we can.
I hope you're right.
One thing I get asked all the time, maybe, and I'd be curious to know what you tell, because I think a lot of people probably take your course when they're starting out, right? Or maybe they've just started. But what people always ask me is like, oh, how do we start? Or what's the first thing? What do you tell people in real estate?
Yeah. I would say majority of people, a good chunk of people that take my course, usually they have started investing in smaller rental properties, 1 to 4 units, like to separate the buckets. What you and I invest in are called commercial residential properties. It's 5 or more units. The analysis of the real estate market is the same whether you invest in commercial residential, 5 or more units in an apartment building, or whether you invest in 1 to 4 units. So the analysis of market fundamentals, population growth, wage growth, investments in infrastructure, all the market fundamentals are the same regardless of which bucket, right? Small rental properties or large or commercial residential. So that's the same. But I think people come to want to invest in larger apartment buildings of 5 or more units once their credit has maxed out with investing in smaller rental properties, because one of the metrics that banks use when you invest in smaller rental properties, 1 to 4 units, is your TDSR, your total debt service ratio, which is based also on your personal income. So sooner or later, generally speaking, people's income is finite, and so you get maxed out. I think the ratio used to be somewhere in the 44% vicinity. So that's when the banks will say, well, you've taken all the credit, you've got all the financing that you can for your smaller rental properties. I cannot lend you money for small rental properties anymore. Then they look at multifamily properties, 5 or more units. Why? Because your income is not really relevant. If I go back, and I should have pulled out my hat. You don't know this, Shane, because you took the course. You took the course online, right? And when you take this course in person, it's way better. And now, of course, I've got way more content, but I'm re-recording everything, so you'll get it. So when I teach this stuff, I'll wear different hats. Okay, so now I'm going to wear my CMHC hat. Okay, when I was a former underwriter. And when I would look at somebody's file application for financing for an apartment building, the income is the last thing I would look at. I would look at to make sure that, verify the income and the expenses, and then making sure that the debt coverage ratio, that my net operating income, that's the income before you service your debt, was at least 1.3, okay? NOI divided by your annual mortgage payments, you get a ratio, not a percentage. And so if the property has a positive debt coverage ratio, that you get more money coming in after all your operating expenses and you've serviced your debt, then that's a sound investment. But if the ratio was tight, like let's say it was like I said, for a 5-year long-term CMHC insured financing, it's 1.3. I would do the numbers and the ratio would be maybe 1.28. Then I might look at your income to see if you could supplement the property's cash flow in tougher times. Okay. But generally speaking, the property has to cash flow on its own, irrespective of the investor's income. So that opens up new doors for investors. So that's usually when people have maxed out their credit on the small rental side, they move to the bigger stuff. And I know that there's better economies of scale, the big lift effect that I talk all the time, or the big wealth effect factor, which the driver, the value of the asset is your NOI, your best friend. Shane, as you remember, I always say that when I teach. And every time you increase your NOI, to give a concrete example, I'm going to go by memory here. If I increase my rent for one unit by $1 or $25, there's a wealth multiplier effect. For every dollar in increased NOI, the property value will appreciate somewhere between $16, $25, $30, depending on how compressed the cap rates are. So you can force appreciation, which you cannot so much with smaller rental properties because the income is not the driver of the value, right? So it's a different income valuation approach, the comparison sales approach. So that's sort of where to start. And it's interesting. I'm going to toot my own horn. I'm actually, before I jumped on this call with you, I'm going to be launching a bunch of master classes in March, free. And it's real stuff and real case studies. I teach experientially. But I'm also going to be having a mini course, which is exactly about what you just asked me, how to get started. Unlike small rental properties, you got to plan your stuff. You can't overnight say, hey, I'm going to become a multifamily investor here. You kind of did it, but you were a different oddball. You sold your business back in Manitoba. You had a bunch of cash. You came in when everybody were scared during COVID and all that. But your route, you understand that is not the common one, right? But generally speaking, you need to know. So basically, I'm going to be giving probably for minimal cost, what you need to do, what you need to think about, giving an overview of the entire process of investing. You need to plan ahead of, why do you want to invest in multifamily properties? Is it for cash flow? If it's for cash flow, then you better put a larger down payment if that's your thing. Or is it to protect your hard-earned capital from other investments? Or, so because you'll structure the financing according to your investment desires and goals. And if, like me, you have shareholders, you got to make sure that my investment goals are the same as those of my shareholders. So kind of question, you got to have an understanding of what's going on in the mortgage marketplace right now. What are interest rates like? That's something, I talk to a bunch of people all the time in the industry, whether it's mortgage brokers, many of them bankers, because I have direct relationship with bankers. You want to know, before you start crunching numbers, well, what are interest rates like at, for example, a $2 million loan amount? So I teach that, but it requires you to do some planning here. I'm being very spontaneous, but when I teach now, you didn't have the benefit of that, but that's the entire investment process here. And you see it's not the newest one, but it starts with you, your investment goals, your tolerance for risks, and then what's the market like at a glance. So basically what I'm teaching, I'm going to be giving that portion of the course to people, maybe for a nominal value, but they can see what I'm offering. And so that you got to plan your move is what I'm trying to say. Because the risks are greater, but the rewards are commensurate with the level of risk. But everybody expects you, and it's funny, that's the part I was reviewing in that mini course. Everybody expects you to behave like a pro upfront. Whereas if you invest, you're going to buy a home to rent out. If you screw up, you're always going to be able to find another realtor, another banker to work with you, a quarter bank. In your world and my world, especially you and I in Edmonton, even very tiny, incestuous world, I would say, if you screw up, you're going to be blacklisted. If people detect that you're not professional, you've not done your planning and your research and your homework, you're going to be blacklisted. And it's happened before to people wanting to invest in multifamily properties.
Yeah. I always, when people ask me where to get started, and I always feel like I probably it's contradictory because I did start initially with a smaller property, but I just, the business is so different done on a 4-unit or done on a 50-unit. It's really a different thing. And that's the starting with the, what's the intent? I think a lot of people, I don't always want to tell people like, oh, you're better off to probably, invest with someone who's already doing it on a large scale. But if the intent is actually to make money, I think sometimes if the intent is to learn the business, then buy the small property. But I don't. I always have trouble giving people that advice because I think it's hard to make it work on a 2 or 4 unit to actually make it worth your time.
There are little economies of scale, but everybody's different. You and I, Shane, think alike. So, yeah, but there's no economies of scale. Like the more units you have within the building, the more money you make. Your cost of operating each unit goes down the more units you have within the building. So for sure. But it's okay to cut your teeth on smaller properties. Nothing wrong with that, right? So,
So the ideal person to take your course, is it someone who probably are they working, doing something else and wanting to get into real estate, or who are you kind of?
I'm targeting everybody. I don't skip steps. Even the first few modules, I go over very basic stuff because I don't want to assume everybody has my knowledge. And I use a coach, like a digital coach consultant, to structure the initial course years ago. Spent a lot of money, tens of thousands of dollars. So it would apply to anybody. But again, the soul searching aspect of it, why do you want to invest? What's your vision? What's your tolerance for risk? What level of effort are you willing to put in? It's one thing to want to do it on your own, but if you want to keep your full-time job, maybe you're better invest with a Shane or a Pierre-Paul, because I'm like you, I'm open for business always with investors, so that you can do. Or if you have young children, when I started, I had young children. My first building I bought it with a friend of mine in Edmonton. So it all depends on your specific circumstances. But the course is for anybody willing to roll up their sleeves. Anybody who understands this is not short-term investing. This is not get rich overnight. This is hard. Like I said, I reiterate what I just said. People are expecting of you, the stakeholders in the business, expect from you a high degree of professionalism, keeping your word. It's very high. The standard is much higher. And it's the same with banks, lenders, anybody, engineers, anybody who's going to deal with, and the buyers. Tire kickers, not allowed in multifamily investing. So it's for anybody willing to do the homework. I'm not trying to sell my course. You take it, you don't take it, I'm no worse off. But I would not encourage people to do it without doing their homework. But the course can be taken by anybody, but there's work involved. You know that, and I know that you can't skip steps here.
Yeah, and I would encourage people as well. Any kind of education or course or something you can compress time with if you take a course and learn stuff that might have taken you years to learn on your own. I always think is worth it. You mentioned there the being well read. I see all the books in the background there. What are you reading now, or do you what's the top 3 if you were telling someone?
A marketing book, right? Because I'm in a marketing campaign with my own stuff. So I'm reading What's in It for Them by Joe Polish. Because all of us are marketers, whether we know it or not. And Joe Polish created the Genius Network and hangs out with very smart people like Dan Sullivan, Richard Branson, and people at a high level of thinking. And so how to approach that, and, how to create a genuine relationship with people that you sell to. So that's what I'm reading. Before that, I just finished just last week, Indistractable, just the power of focusing. Before that, I sold one of those books on, that's very fascinating book just a few weeks ago. I read, like I said, fast. Went to law school and I just read super fast. Sold Out by James Rickards, a former CIA guy, about the supply chain issue, how things are going to get worse before they get better. So I hate to say. Anyways, but some of the best books I've read. Depends on what, I like James Rickards. I've got a few books I read by him, but I found at a personal level, A New Earth by Eckhart Tolle, for me was quite a revelation. And it's one of the most difficult reading. So years ago that I've read and reread it because it's so difficult of a reading. But it's about understanding one's ego and that little voice inside of you and how to, cope with that. And we all have that. So very difficult reading. But to me, that was a very powerful book in that regard. Of course, there's classics like The War of Art by Stephen Pressfield. It's about perseverance. I mean, I read so much. It's so much. I've got so much here. But one book, Napoleon Hill. What is it? That famous book here, Think and Grow Rich. Obviously, I think in terms and I think something, Shane, if that leads me. Your question leads me to go back a little bit to our discussion about when you want to invest in apartment buildings, and it's very cool. When I interviewed you, when I found out your story last fall, when you want to invest in larger properties like that, depending on your background, and yours is humble like mine was. I come from a large French Canadian family in a mining town. Like I didn't grow up with owning a portfolio of 22 million. Nobody in my environment, except maybe one of my friends' dads. But you got to question your relationship with money. If you want to make money, you have to spend money first of all. So I always say, don't cheap out on your way up. And so you got to be willing to spend money and think in terms of abundance. And again, I think about Napoleon Hill in that regard. So that's a mindset. When you want to make money, you have to change your mindset. And many of us, like I said, came from humble beginnings. And it's something that's a bit more difficult to do, but it's not really difficult. It's just a conscious choice that you have to make. People that make money, and like I said, I hang out with a lot of them because they're in oil and gas, very rich people. They think differently towards money. So, and I think that's what reading does. So that's some of the few books I've read in recently, but yeah, I'm always reading. Yeah.
That's good. Well, I'll give you a rec. I'm reading right now or listening to, and I think it would fit right in on all yours. Is A Hacker's Mind. Have you
A
ever heard of
Hacker's
it?
Mind? No, that sounds like yeah.
It's written by a computer hacker, but he talks a lot of it's on how the really wealthy people in the world they're kind of hacking the system. Like he talks about
Okay,
even
cool.
a lot of like money laundering in real estate, where the guys, all those people always wonder why they're buying these expensive places, let them sit empty. But he's like, they can buy it, put the money in, and pull the money out without.
Oh yeah. Okay, cool. I
Especially,
took it. I wrote it down. Thank you for the
yeah.
suggestion.
So that's pretty interesting. I'll end one last question. So obviously in Canada, we got the oil here and the immigration, everything. Would there be other markets you'd look at, or you'd stick to Alberta, or do you like? I know you're friends with the Rockstar guys there.
Well, those guys are doing very well in Toronto, GTA, and you just need to take action out there, right? Because the immigration, the population growth. So it was an easier market, but the opportunities are going to continue there in GTA. Excuse me. The only problem, this housing crisis there is going to get very bad. It's already very bad there. So I considered buying out there in the Golden Horseshoe, around from Toronto, going around to Niagara Falls, that area, the peninsula. A few years back, I checked out properties in Hamilton, along St. Catharines, all the way to Niagara. The problem when you have such a density of population in a market like that is you got a stampede, and valuations are going through the roof. So the upside is somewhat questionable, but with the demographic pressure, and people tend to go to all these large centers, right? Immigrants. So I think there are still opportunities, but you got to be careful. And I think you need to have perhaps a longer investment horizon. Whereas you and I here, we're coming out of a dark place, like I said, the last 6-7 years, and there's much room to move up in terms of valuation. There's lots of room to increase rents and valuations of our properties. So we're in a good place. I would say, again, having underwritten properties across, 3 provinces, a couple of territories in Canada, don't necessarily overlook the small rural markets, whether it be in Manitoba, Northern Ontario. I know a guy up in Northern Ontario, Curtin Lake, which is not too far from my hometown in Quebec, because my hometown is Rouyn-Noranda, is a half hour from the border with Ontario, has been making a killing buying property, Shane, for like 8% cap rate. Doesn't have the competition that you and I have. So it's not always happening in the big cities. There's different strategies. You'll go in the market, buy for a much lower value per door. Just got to be careful. Sometimes those markets are not as diversified, so you got to mitigate that risk accordingly. But because of the housing crisis, all markets are still going to be good, because the supply shortage is so severe in Canada. Any market will do well, but some markets will do better. I think Saskatchewan is another one like that will do also better, because similar reasons to Alberta. So, but yeah, there's not enough housing, so we know that values will continue to, they've come down. I think what we're seeing on the single home market, that's a correction. But with the demographic pressure, we are under already. I think it's short-lived, just a short-term correction in the principal home market. My take on it.
That's good. Yeah. Well, I'm obviously bullish Alberta. I think we're one of the last cash flow markets. A lot of those other markets, will be very good, I think, on the appreciation side.
Yeah.
But well, Ender, do you want where's the best place for people to?
Well, so you can reach me. So Shane, I've got a bunch of master classes coming up in March. They're free and they're like hands-on. I use actual case studies, like real deals, some of mine, etc., to illustrate everything I'm teaching. I'm going to be talking about cap rates, financing, obviously, and how I attract capital. What I share concrete to how to do that. So that's in March, starting March 5th. They can always go to multifamilyinvestingcanada.com, Mick, www.multifamilyinvestingcanada.com. That's March. More stuff is coming on. And also my next 3-day workshop is March 31st to the 2nd. It's a 3-day workshop. And I was supposed to increase my prices. I understand that these are difficult times, so I'm actually lowering my price a little bit. So again, you can go to multifamilyinvestingcanada.com. People interested in investing with me, I'm open for business. I'm actually actively looking in 2023, and you can reach me at Turgeon@Matterhorninvesting. I work only with accredited investors, so that means that you have an income over a couple hundred to $250,000 a year. But we can discuss that, and you fill out a questionnaire, make sure we're in sync in terms of what all the things that I talked about, investment horizon and investment goals and all of that.
Well, thanks for coming on, and we'll put the links in the bio so people can get a hold of you.
Fantastic. Well, thank you so much for having me on, Shane. You be well. Cheers.